A few weeks ago, we shared CREA's 2022 forecast for price growth across Canada and highlighted the fact that Ontario was the frontrunner at 11.5%, outpacing the rest of Canada, which averaged at a much lower 7.6%. Now, after that, we got a request to do a growth breakdown within Ontario. And because most people watching our channel are based in Toronto and prefer to invest somewhere within driving distance, we're going to zero in on the Greater Toronto and Hamilton area. If you've been following the real estate market, you probably know what's happened. UBS said 2021 was the end of urban outperformance around the world, and Toronto was no exception. Going directly into the numbers, the suburbs did outperform, averaging 60% in price growth throughout COVID, whereas Toronto was lower at 27%, even if we ignore condos, which wasn't nearly as high. Honestly, that's still very good, but if you compare things on a relative basis, these suburbs did do much better. But now we know we're slowly making a COVID recovery, and the economic situation is changing with rising interest rates. So in this video, we'll take a deeper look into how prices in the GTHA will move in the next few years. Based on what's happened in the longer term history and over COVID, we'll give our predictions on where the best areas might be to invest in moving forward. If you enjoy content like this, don't forget to give this video a thumbs up and subscribe to our channel so you can see more videos like this made specifically for real estate investors in Toronto. Before I start, we want to remind you that this information is for educational purposes only and not financial advice. We recommend that you do your own analysis and speak with a financial advisor directly if you need help with investment decisions. Now, in one of the previous videos I made, I compared how detached properties, semis, and condos in the 416 Toronto area performed, and the conclusion was that semis, which can be generalized to include all freehold investment properties in Toronto, make the most stable and best investments. After that video, we had a lot more interest from investors looking for freeholds, but also wondered if this applied to the 416 area only or whether this was the same across the board in the GTHA. If you want a short answer, there is a difference, and the freehold investment outperformance as rates go up is specifically for the 416 area. When it comes to real estate, there are a couple of things that impact how a market moves. First of all, the further away you go from the core, the less attractive it is, and so the purchase price tends to be lower, but also because of that, there tends to be a smaller portion of renters further from the core. In other words, you'd have lower priced properties and more end users in the suburbs compared to the 416 area. Real estate is largely affected by interest rate movements, especially in the end user markets. As interest rates drop, mortgage payments come down, so the more affordable suburbs appear even cheaper. So we end up seeing a spike in suburb demand when interest rates come down and more buyers are willing to compromise longer travel time for more space and a better discount. Now, COVID has stimulated this effect even more because work from home now became a norm. So in the past 2 years, the prices in the suburbs went up even faster compared to a normal downturn. Assuming we're purely looking from an investment lens, let's see how 416 semis performed over history compared to Oshawa, Newmarket, and Hamilton. Let's start with the end of 2014, the previous cycle where rates started to drop. You can see that rates dropped starting the January of 2015 and then held stable and low for a period of 2.5 years. Now, if you entered the real estate market in 2014, you would have done the best by 2017 if you bought in the suburbs. Hamilton gained the most during that period, followed by Newmarket and then Oshawa. On average, those three cities saw a 68% growth in prices, whereas Toronto saw a 41% gain. Now, if we skip over to our current cycle over the last 2 years, this trend repeated again. What's even more clear is that because of the extra COVID and work from home effect, the suburbs did even better relative to Toronto this time around. And you can also see that the growth moved in line with the price point. Oshawa is the most affordable, and so it saw the fastest growth, followed by Hamilton, followed by Newmarket. On average, these three cities saw a 63% gain, whereas Toronto grew 27%. Now let's see what happens when interest rates make a U-turn and start rising. As interest rates rose from June of 2017 to March of 2020, the area that grew the most during the almost 3-year period was Toronto. Newmarket only saw a 1% growth over 3 years, whereas Hamilton and Oshawa gained 21%. On average, these three cities grew 14%. So if you invested in real estate in mid-2017, you would have made 19% more in Toronto compared to the suburbs. If you're wondering about rent yields, they're actually pretty similar across the board nowadays. Before the spike in prices in the suburbs, you might have been able to get better rent yields further away from Toronto, but now that prices have shot up so much, we're looking at very similar 3.5% to 4% in net rent yields everywhere. In other words, the bigger thing that affects returns nowadays is appreciation, which is driven by budget. Right now, these suburbs are still priced lower, but it's not nearly as much as before. You'd need around $200,000 of capital to invest in a house in Hamilton or Oshawa, and $280,000 of capital if you wanted to invest in Toronto for better growth moving forward. Another interesting thing to point out is that when rates dropped in 2014, the suburbs outperformed Toronto by more than half. But this time around, the suburbs doubled Toronto's growth, and that's probably from the extra COVID impact. Realistically speaking, spending more time working from home will be a permanent change for many people, so I don't think that the COVID shift will fully unwind. Even still, it's not unreasonable to think that some of those people who left might come back to the core if they can't stand living so far away from the action. So, on top of the regular outperformance in Toronto when interest rates rise, it's also very possible to see an extra COVID recovery bump for Toronto. But let's just assume Toronto outperforms by 19% this time around when rates rise, similar to what happened last time around. Once you factor in leverage because we're using borrowed money to make more money, we're looking at over 75% more in ROI. So on a $280,000 investment, that's $213K more in absolute returns, which is huge. Now, the last thing I wanted to say was that for this analysis, I kept it simple and chose 3 cities in the GTHA, which are actually extremes. Places around the GTA like Markham or Mississauga are actually somewhere in between the cities that I analyzed. And I'll be posting some of the other numbers on our social media accounts, so you can head over there to get more insights if you're interested. Here on our Elevate team, we focus on real estate investing solely in core Toronto, and we know this market inside out. So if you're ready to invest in Toronto and you want a team that can show you the best deals out there, we'd be happy to connect. We can look at your requirements and preferences and then match you up with an investment property that fits your needs. After we help you buy it, our team also provides renovations guidance, leasing, and property management if you need it. So just connect with us if you want to learn more about our services by heading to the link in the description below. Don't forget to give this video a thumbs up and look for us on Facebook, Instagram, or LinkedIn to hear from us more regularly. I wish you all the best in your real estate investing journey. Thanks so much for watching, and I'll see you in the next video. Bye.